We're looking for these levels up in here. This dashed line and this dashed line here is the optimal trade entry levels respective to this high and this low. The weekly fair value gap levels are annotated in that heavier dark line, and then the discount to premium level. We were looking for it to drive up into that in here, but it ended up falling short of that and it started consolidating. I placed a filter, and this was respective to the algorithm. So I do not want to see Thursday's range violated. Initially, we were looking for it to run up in here, and then I changed my mind and said, okay, well, we're going to look for the continuation on the dollar going lower. And then it just consolidated and didn't do that. So I gave a filter for Thursday of last week. I did not want to see Thursday's daily range violated. So here's Wednesday, today's trading, Tuesday, Monday, Friday, Thursday. We violated Thursday's high right here on Monday. So that sets the stage for what? Resuming the idea that it was going to trade up into this premium level. Now, premium is something you'll learn in the PD array matrix and how to frame a visual representation of what overbought, oversold is without indicators when we're working within a range. Okay, so a dealing range high here and a dealing range low here. And I know this seems like I'm going way too fast and over your head. Take your time. So Thursday on Monday, that Thursday high was violated. So that set the stage for the filter. And you'll hear me talk about this in the previous. So with Thursday's high being breached on Monday, that means the likely scenario, the volatility expansion for this particular week should be on the upside if last Thursday's high is violated. And we're going to try to draw up into this area here. Okay. With that said, we had FOMC today, and the market did in fact make an expansion higher. So the move of this week so far, the largest range is what? On the upside. So on Monday, we had our indication given to us that Thursday's high was breached. So daily bias switches to what? Bullish. So let's go to the next time frame. It's the hourly chart. All right, so here's the hourly chart or 60-minute chart for the US dollar index. So we had all this sell-side liquidity. They left it in here. The Monday's trading, Friday, Thursday. Thursday's high being shown here. We traded through that on Monday. So that sets the stage for what? The volatility on the large end or the magnitude of the weekly range expansion is going to be to the upside if Thursday's high is broken or was to be broken. Before I go any further, let me tell you the reason why I said if it was going to go above Thursday's high, and Thursday usually caps the weekly range. And because I'm anticipating a specific criteria of seeing the movement on price expand out. I don't want to say breakout because breakout kind of, implies that I'm guessing. No, there's a specific level I'm looking for. It was Thursday's high. And it's relative to the idea that the algorithm uses Thursday to cap the weekly range. Now, if we have a down move on, say, for instance, euro. If euro's going lower and we made a high of the week on Tuesday, I anticipate most of the time, not every time, but most of the time, the Thursday New York session will create the low of the week. And it might go a little bit lower on Friday, but most of the time you're going to learn that Thursdays generally cap the week. And Tuesday makes the opposite end of the range. Not all the time, but that's usually what I'm anticipating going forward when I'm bearish. If I don't get something to sell off on a Tuesday, then I'll look for the same criteria on Wednesday. But I'll expect a larger, faster move on Wednesday going into Thursday's New York session open. Okay, and then maybe they'll bleed into Friday's trading and go a little bit lower. But generally, Thursdays make the opposite end of the range. And you can see that pretty much being illustrated here on the dollar index. You can see here's Thursday, which is the 21st. We trade down, create the low. The week doesn't go any lower on Friday. You notice that? And then here's Monday's trading. So if we trade above Thursday's high, that to me indicates that there's going to be a change in the delivery. Okay, so when there's a change in the state of delivery, and the change of delivery, okay, is basically just another way of saying a short-term change in direction. All right, the change in state of delivery from bearish to bullish. So if it's moving bullish, and we know this on Monday when it trades above Thursday's high, which is here, anything as a decline is to be viewed as a opportunity to buy because the market's going down into a discount. If we look at the low to high, that's our dealing range in here. Midpoint's about in here. I'm going to eyeball it because I didn't want to add it to the chart and have more lines than is necessary. But we went down below it, so this means the market moves to a discount. I want you to take a look at this last down close candle here with the lowest down close. That is your bullish order block. It has a small little gap in here, right there. So you're associating two things that make up a strong bullish order block. I'm going to give you something that all of you are dying to know, and it's probably the first thing on your list. Which order block do I buy? Which order block do I sell? So the market trades down into this last down close candle, bullish order block. When we get into the lower time frame, 15-minute chart, you'll see there's a fair value gap there. It trades right into that. And then the market creates an opportunity to go higher, runs into the buy side liquidity. Now, buy side liquidity is, think about it, any old high or relative equal highs, that is where buy stops are going to reside. They're going to be using that area to think of it as resistance. And traders that are going short here, okay, they're going to have stops right above that. The stops that are utilized above a high is a buy stop. They're using it to protect a short position, because the idea is if it goes up there, they don't want to ride something that continuously goes higher and have, you know, an unlimited amount of loss theoretically, or until they're margined out. So above old highs, it's buy side liquidity. Below old lows, it's sell side liquidity. We have a run up in price. The market consolidates, creates a down candle here, rallies up through the buy side liquidity pool up into the last up close candle, which is a bearish order block. A bearish order block is not necessarily an opportunity to sell short at. In this instance, it's a target. So the market's trading up into here. Now there's buy side liquidity resting above this high, just like it was here and here. So I'm anticipating Thursday into Friday that the dollar index could make another run higher and trade up into that premium level. Now this is that premium level that I identified and annotated on that daily chart. All right, so here's the 15-minute time frame for the dollar index. This is a volume imbalance. Volume imbalance is that little separation between the body's close here and the body's opening. There's just wicks from this tail and this wick. So there's no bodies overlapping in between the opening price of this candle and the closing price of this one. That is what I teach as a volume imbalance. It's the same thing as a real gap. Okay, so if there was an absence of any kind of trading between a particular price and another price, that gap is what everybody knows as a common gap. This doesn't show a common gap. It shows just a wick and a tail in between these two price points, the close of this candle and the open of that. That is a very sensitive point of price. It's algorithmic, and it will literally reach back into that level right there in the future. Bang. See that? Trades into it there and then starts to rally. We have a high, the low, and a higher high that runs out to buy side liquidity here. Here's that Thursday's high. Remember I was telling you that before the week started, I said if we trade above Thursday's high, then I'm going to go back to thinking that the dollar's going to go higher. So any discount, we want to see it as a buying opportunity. Here's that little fair value gap I mentioned on the hourly chart that we would see clearer on the 15-minute time frame. The fair value gap is defined by this candle's high and this candle's low. So it's one candle going up in between those two price points. So anyway, this is a buy side imbalance, sell side inefficiency. That means that it's just one single candle. It's a larger version of this, just extended over a larger range. Okay, so basically buy side imbalance, sell side inefficiency is the same thing as a fair value gap, but just over a larger price range. Same premise behind it. It's just one single candle that passes through two specific price levels and no counterpart movement lower, or in this case where the market went higher here. So all of this price action here is being held up by this one single area here and in a small little point right there. So it finally collapses and goes back down to a discount, or in retail terms, oversold. Okay, we don't need to see an indicator to tell us it's oversold. If you plotted an indicator that was oversold, overbought on here, it would get probably close to these areas, but we are not looking at just overbought, oversold. We're looking at areas where the market is inefficiently delivered, and it will go down to those levels perfectly and then give you a bounce. It fills in this little area in here, but this breaker here You can see that traded to here, and then it trades down into that fair value gap. So we got really deep discount pricing there on the 26th, so during Tuesday. So Tuesday creates the low of the week thus far, rallies up, it comes back down in. Consolidation one more time into an order block, volume imbalance, trades into it here, rallies up, buy side imbalance, sell side inefficiency. In other words, it's created an imbalance here, too fast, one-sidedness. And the next candle here that closes the buy side imbalance, sell side inefficiency top end. In other words, the boundary that creates the high end of it, whereas this is the low end of it here on this candle's high. The very next candle that drops down into this area here, that is what I teach as an institutional order flow entry drill. It's a way for you to enter a trade in a market that's already started moving and you're not chasing price. You need to have the best entry here, here, or here, or here. You can buy in it here, and you have all the logic back here that says, okay, I don't need to be fearful of it coming down here to stop me out, or down here to stop me out. And this would be like a conservative entry point because you have buy side liquidity up here that's going to attack. Remember, all of this move here was set up as a run higher if we went above Thursday's high, which is what we did on the 25th. And on the 26th, we had a deep dive going down into the New York session where we had a market reversal profile. And then we consolidated going into the Wednesday's trading. We had a small little Judas swing, which is the little move that happens at the beginning of the day into London sometimes. It trades down lower, bullish order block, volume imbalance, starts a rally, creates the imbalance, institutional order flow entry drill. So there's an entry technique right there. You can go long. This is another one here. It's this right here is the same thing with this candle right there. All right, so here's what we have here on Euro. The same thing I mentioned for Euro. I had the algorithmic filter on for any price movement that went below Thursday's low on Euro sets the stage for this going lower, and I'm aiming specifically for this fair value gap right there. So we have this candle's high there, and this candle's low right there. And this one candle only traded between this candle's high and this candle's low, one directional. You see that? One direction. That means this was buy side delivery. Buying only. The price went higher, okay? So that means all this price action is being supported by this one single little area of inefficiently delivered buy side. What do you think the likely scenario is eventually that should take place in this? If it's efficiently delivered, the market should trade down into this area here. So trading down into this area, and this is also a bullish order block. So, and it's also a weekly fair value gap. So what we're showing here, this little area right there, that's a fair value gap. This low and this high, if you look at a weekly chart, you'll get this same thing here on this one candle. It'll be one weekly candle creating this same thing. So that's what I'm annotating here, a weekly fair value gap. So the range is being defined as such. All right, so we had a buy side liquidity pool in here, small little residing fair value gap right there, didn't quite fill in enough, overshot it there. So we had buy side liquidity taken, imbalance, rebalanced here, and trade up into it one more time. Last up close candle, bearish order block, it trades lower, creates a sell side imbalance, buy side inefficiency here. So it's basically like a fair value gap with a down candle. Okay, it's defined by this candle's low and this candle's high. And this right here is an institutional order flow entry drill. I just don't have it in the chart because it would be too busy in the chart and too many things being pointed out for the new people. This is probably already too much as it is, but you got to come in here expected to learn, and you're going to get a lot of information, and you have to do a lot of homework and note taking. But this is an opportunity to see it sell off here, and then it sells off lower, taking out the Thursday's low. So taking out Thursday's low is the algo filter I gave you in the weekend commentary. It does so here. Any rally sets the stage for what? A sell-off. So what is it going to do? It's going to go up into this area here, rebalance that. Look at all the bodies of the candles in here. Okay. Yes, we have a wick that goes through it here, and a small little wick that goes above it, above this fair value gap. But this wick only reaches up into the order block, this last up close candle that has the body on it. So you always anticipate that as a likely scenario, but the bulk of the volume, the majority of all the trading institutionally is right here in this shaded area. You see that? This is a signature that we like to see. We like to see this very thing happening. Then the market trades up into half of that gap, or fair value gap, trades there, and then breaks lower. Sell side liquidity is attacked there. On the hourly chart, you can see that the breach of Thursday's low is here, right there. At that point, any rally up sets the stage for the market going into a premium. So it's this low to this high. There's your dealing range. So if we go above halfway of that, that would be a market that is considered at a premium, or would be referred to as a overbought market. By itself, it doesn't mean anything, but when you compare it with areas like this, and it's overbought, or it trades into an order block like this, that means something now. So now you're blending two things. You're blending time and price. Time and price. Where is it at in reference to this low and this high when it's trading here? It's in the upper half of the range that would be defined by this high to that low. So this is overbought, and we don't need an indicator to tell us that it's overbought. If that criteria is met and it trades to a PD array, which in this case here is a SIBI, sell side imbalance, buy side inefficiency, that is the same thing as a fair value gap. It's just over more range, more pips. Okay, you're going to find sometimes I use them interchangeably, and it's just a matter of thinking about it in relative terms to all of the price action around it. So this could have very easily been identified as a fair value gap because the parent PD array or category for it is fair value gap. Underneath that category, you have a sell side imbalance and a buy side imbalance. So it's BISI or SIBI. Buy side imbalance, sell side inefficiency is one single candle up. A SIBI is a one single down candle, sell side imbalance, buy side inefficiency. And what it means is it was only selling here and nothing until the market went up here offered buying. So in other words, the pass through on this is going lower and it passes back up in that same area here. So it efficiently balances the range between this candle's low and this candle's high because it offered delivery of price on the downside as it was dropping. But what happens if you wanted to buy it? You didn't get a good chance to buy it because it was moving only one-sided. So over here, the algorithm goes up in that same range and it offers buyers opportunity to buy it. It does not mean it's a good place to buy, and it does not mean it's always a good place to sell. It just means that this is an inefficiency, but when you put it inside of the narrative that Thursday's low was taken out here and it rallies up to an overbought condition and it has a PD array that's a premium or considered overbought, then you're blending two things, time and price. And when that happens, you get these types of results where it attacks this low and trades into this. The rejection block is the down closing price inside of a swing low. So we have a swing low right here. Okay, that closing price is the rejection block. Then you have a lower low. I taught just recently that if you have this situation here where you have a low and then it's violated with a lower low and then it runs away, you use the first low in the lowest down close. That's your true rejection block. The market trades down into it, doesn't go below this low or below this lowest down close. Notice that? And then it had this retracement up into the bearish order block. So we're going to see if it, after it's already closed in this small little fair value gap there, look at the bodies in here. So we're going to see if it has a willingness to go lower and attack that sell side liquidity. Because if we're going to see higher prices in dollar, and if that is in fact what happens, because there's no perfect track record. I don't have 100%, but I have to tell you what I think is going to happen. And if I'm wrong, I'm comfortable because I'm not trading in January. But as we get closer into the February and deeper into the February, you'll see that it's a lot easier, or it should be a lot easier to read price, and I'll be a lot more confident in what I think is going to happen. But right now I'm saying that I think that Euro may attack the sell side liquidity here. Okay. All right. This is what you're going to be doing. This is the legwork as well. Every day you want to look at your 5-minute chart. So around noon time, well, noon is over here. This is 2 o'clock in the afternoon. That's about as long I want to watch price. I don't care anything after that. And most of the time it's at 12 o'clock that really finishes it for me. So we had FOMC today at 2 o'clock in the New York time. So that's here. And I don't want you to think about this time frame all that much. I want you to be defining your days with noon to midnight or midnight to noon. Okay, and that's going to be the lines portion of the daily range. And everything that you frame out in your chart, you want to keep that within that context. All right. So on Monday, we had the violation of the dollar index trading above its previous week's Thursday high. So that set the stage for lower prices in euro. So here's Monday's trading. Market trades up into a rejection block and London open kill zone. This is not an indicator. I physically draw this in a rectangle, and the times are 2 o'clock in the morning New York time to 5 a.m. New York time. I just make a rectangle that's big enough that I can type in this. Okay, and New York is 7 o'clock to 9 o'clock in the morning New York time, and London close is 10 o'clock to noon New York time. So we have a sell side imbalance, buy side inefficiency, single pass through down candle here. Then we have its candles high and this candle's low. If it trades back up to that candle's high, which it does here, or above it, you can go short there. It doesn't need to come all the way back up and touch this bearish order block or fill all this in. In fact, it's better if it doesn't, because it shows in a very clear graphic depiction of heaviness. It wants to go lower. And then once it starts to trade lower, it happens again. We have a small little fair value gap there, defined by this candle's high. If it trades that candle's high, it does here and here. This is an institutional order flow entry drill as well as this one is, and you can sell off there. It's not a lot of pip, but if you're looking for 10 pip runners that you can just scalp all day long for practicing, it's just a beautiful little way of doing it if you know what the market's reaching for. So this is a mitigation block. Also, it trades back up into that within this fair value gap that did not close until here. Look at the bodies of the candles. Yes, we have little wicks above it, but look at the bodies respecting that specific gap right here, defined with this fair value gap. Beautiful delivery price. Trades off lower, come back up, bearish order block, small little imbalance here, hits the bottom of the fair value gap, and breaks lower. Retrades, consolidates, breaks lower, retrace, breaks lower, bearish order block, mean threshold there. Sells off, attacks the sell side liquidity here. What's sell side? The opposite of what I explained earlier in the video. Above old highs is buy side liquidity or buy stops. What's resting below this low here? Sell stops. Why? This market started to go higher. Somebody's long. So how do you protect a long position? You put a sell stop below some particular price level. What do you learn in the books? Below the low? Well, that's what it's running into here. And it's trading into the optimal trade entry levels relative to price action that you can study and figure out what these are here. And the London close is 10 o'clock to noon, and that's usually when it makes the opposite end of the range. Okay, so you have London creating the high today, well, specifically back here, but it does create almost the equal high here. Sells off, continuation in New York, opposite end of the day, daily range between 10 o'clock and noon. Many times it's going to be between 10 o'clock and 11 o'clock New York time, but the window I teach you is 10 o'clock to noon. All right, so these times are static. Don't move them around, and you'll see they pretty much serve you all year round. 1 euro in the 26th of January. So this is Tuesday's trading. So the market trades lower, below the previous day's low. We have buy side liquidity here. The market rallies up, creates a small little imbalance here. Buy side imbalance, sell side inefficiency. So one single up candle, to be balanced efficiently, it should have down movement into the same range. It does so here. Almost completely closes it in perfectly. Not quite, but it's enough. Then the market comes back down again, and one more time into it, finds some support, runs. We have a mitigation block here. You learn about mitigation blocks in month 4 content, and it starts to accumulate in here, rallies up, optimal trade entry during New York session, rallies up, institutional order flow entry drill, because it only goes to this candle's low or lower inside of this imbalance. You can be a buyer here, scalp it, run up into target here. This line right here, all this is looking at the bodies here and here for optimal trade entry. There's your buy. It rallies up and hits that perfectly. So the market creates a small little fair value gap here. And again, this is a institutional order flow entry drill as well. This is consequent encroachment. Consequent encroachment is the midpoint of any imbalance. Okay, so the imbalance here, the midpoint of that, like for instance, if I teach a order block, you all know, because if you've been watching my YouTube channel, midpoints or half of an order block is what I teach as mean threshold. In gaps, which is an inefficient delivery here, or in wicks and tails, I teach the midpoint is consequent encroachment. Okay, that's the midpoint, what is acceptable without filling the entire gap or imbalance in. Midpoint is usually very sensitive. This is an institutional order flow entry drill technique here. You could be a buyer here and get 10 pips out of that run there to get to that target. So you had a target from here to here that could have been 20 pips. You could be buyer here to here and get 10 pips. And you missed all this as ideal entries. So as long as you have time, remember the first thing I teach is the algorithm operates on time. It hits the high of the day inside of London close. So in here, this one's not as favorable as this one because this is outside of the time window of London close. This one's more likely to deliver because it has more time in the day before it gets in this area where it generally creates the opposite end of the daily range. So here's London open creating a low of the day, and here's the high of the day forming in London close. So there's your two bookends that create your daily range. Your open, down, power 3, accumulate, buy, reaccumulate, buy, catch some small little entries to either add on to if you've already bought long, or just use them as scalps or practice and run into your target. And the market sells off, trades into the mitigation block, and then bounces in here. Finally, moving into today for euro dollar. Here's the London open kill zone. Again, now this is when the market has already traded up, and we're looking for it to sell off because the dollar index is now bullish. The market trades off, creates a small little imbalance in here, fair value gap, trades up into that during London open kill zone. If you have a bias and it creates this optimal trade entry pattern right there with a fair value gap, man, is that like sugar. It's so good. That is in itself, that is a model right here. If you know your bias, if you know what's likely to reach for, okay, as a directional bias, it's going higher, going to go lower. If you get this type of setup here, this is it. Like, that's all you need. You just need to learn what draws price to where, what directional bias, and time of day. If you see this pattern here, that's it. That is it. That's what makes an optimal trade entry really optimal. It's really, really sweet. When you see something like this, it's just beautiful. Really just perfect delivery of price. Hits the top end of this low candle, in other words, this low on this candle, extend that out in time, trades up into it, fills in all this right here. The one single down close candle, we have up close candle here. So it's balanced. There's no need for it to go any higher. How do you know it's not going to go to this level here? Because this is a signature that I teach, and that's what the algorithm does. It refers back to this point right there. It doesn't need to go up any higher, but your stop needs to be above this up close candle's high because that's your bearish order block. It could tag this body and go into a little bit, so your stop needs to be above there. So you could sell short in here, stop here, and look for the previous 2 days ago. Okay, in other words, this is Wednesday's trading, so Monday's low is here, this line. That's what I'm annotating. So you want to be always looking back 3 days. Count today as 1, yesterday is day 2, and day 3. So 2 days ago is what I'm referring to in this annotation. So it's 2 days ago's low, or Monday's low. And this is Tuesday's low, or previous day's low. So once we get down into Monday's low, yesterday's low, or Tuesday's low, we rally back up. And then what we're waiting for is the displacement. And we get it right there. See that? See how it energetically moves away versus something like this. This meanders, comes back up, yeah. But then you have this real nice push away. When it does that, that's the same thing you're seeing here in what time? New York. This is what your eye is going to be trained to see. You might see this as I'm drawing your attention to it now and saying, wow, I can see the similarities between this and this. It's one single down close candle. It's one single down close candle. It's an optimal trade entry, high to low, retracement. Optimal trade entry, high to low, retracement. It's got a fair value gap. It's got a fair value gap. It's a time of day. It's still likely to go lower. Where's it going to go? I have that line down here. Again, this is not the level I want you to look at. I want you to look at the hourly rejection block and how it trades into it here. I don't want you using this level. I just want you to look at all of the rejection blocks across all the time frames and see how that lines up on your 5-minute chart and how it presents the opportunity for calling at the low or very close to it. And then you have another institutional order flow entry drill. After the sell-off starts here, it gives you one more little fair value gap. All it needs to do is trade to this candle's high on the next one. It does it here. So you can be short there. Stop needs to be above this candle's high. Why? It's a bearish order block. And you frame out your whole trade. I'm giving you a ton of stuff, folks, right now. I have no doubts that 6 months from now, you're going to come back and look at this very first video and say, man, he gave us everything. Yeah, I gave you a lot of stuff right here. You may not feel like it, but I'm giving you all kinds of stuff. This is not YouTube, okay? So institutional order flow entry drill here, and then what does it run? Boom, slams into the rejection block that's found on the 60-minute chart that I showed you on Euro. Once it hits that, you need to be canceling out all of your partials that you would have had and leave a small portion on if you wanted to see it go lower. But since it's FOMC, you really want to be chasing it down and taking out partials and considerable amount of partials only if you're practicing You don't want to be trading ahead of FOMC on Wednesdays or days that have FOMC related things at 2 o'clock New York time. You don't want to be trading that day, but you can see here it works out really nice for practice and or study. Then the market trades off ahead of London close. Now, this is just one of those times where you want to be aware that it's likely to turn. You're going to find that sometimes it will turn at 9:15, 9:30, some kind of speech will come out, or it just hits a level that makes perfect sense, like that rejection block. And once it hits that, then you have everybody, moving to the sidelines on the institutional level, and there's no real interest at all. The algorithm will want to consolidate going into FOMC, which is what you have here, and then it really doesn't do much at all today. All right, finally moving into cable. I'm looking at this low to high. I think that the market could correct down below this low. And this is what I teach as a trend line phantom. After running the buy side liquidity here, and this is also a breaker. Okay, so we have a breaker in here. That level is seen if you go out farther back to the left in your own charts, you'll see what this level is. It's a very clear breaker. And this, I think, is the draw on liquidity if we continuously move higher in the dollar. If we get a real nice pop up in dollar, cable should have no problem getting down here. And if it does that, I'm not necessarily calling it top in cable, but that would really upset any trailed stop losses along the way, because we really haven't had any kind of stop runs since this one here on that low. No stop runs have occurred since then. All right, 60-minute chart. So we have a buy side liquidity pool here. This red line is the breaker on the daily chart. I think that it could have done enough work in here to see it trade lower. And we see this break here. We have a run where it's just a fair value gap delivery on the downside. So this one single candle gets rebalanced right there perfectly. Then we have a displacement lower. It reaches into here on this imbalance. That's a fair value gap as well. And then it runs up into this fair value gap. I counseled my students over the weekend to create charts that just show fair value gaps and keep the levels extended going to the right. And you're going to start seeing sensitivity at levels that would otherwise be unnoticeable to you or anyone else that doesn't know about what I'm teaching. They will act like real support resistance does in books. Okay, because the idea is support and resistance, it goes up to an old level, stops, turns around. If it goes back up to that same level, it's going to stop and turn around, right? Because that's what we're told. That's what the books tell us. But it doesn't always work. I've lost lots of money doing that. And if you look at how imbalances work in the context of price delivery, you're going to be amazed at how price really finds support and resistance on these levels. And what I'm referring to is areas where it's just one little single candle creating a range between the previous candle's high and the previous candle's low. Well, that's not being indicated here. This is actually a 15-minute time frame, and you'll see it when we get down to the 15-minute time frame. But if it was being annotated on the hourly chart, it would be this candle's high and this candle's low. But this is the 15-minute time frame, which you'll see. But nonetheless, it trades into the bullish order block with a fair value gap, and you get this little pop up. Where does it go to? The imbalance right there. Then what's happening? It sells off. All right, so here's that small little 15-minute time frame fair value gap that I told you would see clearer on this time frame. Sell side liquidity pool rested below here, so in other words, there's sell stops below that. We had 1, 2, 3 runs up above the buy side liquidity here, and then we have a break. Now, you all see high, low, higher, high. That's the breaker, extended out in time. No, I see high, low, high, moves lower, comes back up, fails to go above this high, and goes lower on this low. It's the mitigation block. It's the down close candle. Yes, sometimes the breaker might overlap, but my concern is inside that last down close candle there. What do you do with an order block? It's the low, the high, and the middle point, or mean threshold. Find the mean threshold of the last down close candle on here, and bam, there you go. Mitigation at mean threshold. So it's the midpoint. Sells off, and we have what looks like an institutional order flow entry drill in here, but I didn't want to draw too much attention to that because I don't know really what this pair is going to do. I'm going to stand on the idea that I think it's going to go lower based on what I've outlined here and what I showed you on that hourly chart. All right, for Monday's trading, here's the 5-minute chart. On Monday, we have the line open kill zone here. The market trades up, breaks down. So we have displacement, small little fair value gap there, mitigation. Remember what I was saying earlier? We have a high, low, higher high. You see a breaker. I see a mitigation block. Consolidation inside of the fair value gap here, and then breaks lower. Extend it out in time, right in here. Order flow with this mitigation block. Why? High, low, lower high, breaks through it. So it's this candle, the low extended out in time. So you have mitigation there. Look at the bodies of the candle. It's not going much above this closing price. We wick through it a couple times in here. This is all broker related. So your spreads is what is affecting this on your platforms. So we have the mitigation block here, the dashed lines. You can see that being here. And it trades up to the consequent encroachment of that, remember? So it's moving halfway point there and then trades lower, comes back up, mitigation again here. Midpoint, about almost got to it here. So we have another optimal trade entry there. Doesn't quite get to the beginning of the New York session. So this one here, just a little too early and runs lower, comes back up, bearish order block. So now we have another optimal trade entry here. Sells off, fair value gap. This one's better. It's inside of the New York session. Comes back down, spikes up one more time into the fair value gap and optimal trade entry. Sells off, attacks the sell side liquidity here. And then one more pass down lower for offset distribution. Offset distribution. What are you giving me, ICT? When we look for targets, we love to cover shorts or take partials below old swing lows. Okay, just like this low here, you can take a partial here. That would be offset distribution. You're distributing your shorts below old lows to willing sellers. So you're buying back some of the position you're short. So to get out of a short, you have to buy some of it or buy all of it back. Well, here's sellers that want to buy it from you at a low price, and that's what we're doing. So we're taking the ideas of retail traders and we're completely turning it upside down and using it against them. And we're using their liquidity, and very thankful for it too. And the market trades in consolidation into the close at 2 o'clock. Here it is for the 26th or Tuesday's cable trading. Judas swing again during the London session creates a nice little imbalance here. So there's energy that wants to go higher. So you have an optimal trade entry, buy, fair value gap, bullish order block, rallies up, consolidates, expansion. And then we have another small little optimal trade entry in here with a fair value gap coupled with a bullish order block. So fair value gap, optimal trade entry, and order block. That could be your model. That could be the pattern you're looking for within the context of daily bias. Previous day's high, rallies up, consolidation, rallies up more time, institutional order flow entry drill. All it needs to do is trade this candle's price low. And then you can be a buyer there again. And it runs up into the buy side liquidity above the previous day's high into London close, creating the high of the day. Never went any higher than that, consolidating into the close. And then finally, today, we have previous day's high, the daily breaker. You studied the charts for these. And during the London open kill zone, we have a breaker. The market trades lower. 1, 2, 3, 4 times trades into that breaker during really dead time in here. And the market trades aggressively lower. Small little imbalance. Back to the breaker. High, low, higher high. Last down close candle in that. Extended out in time. Breaker. New York session. High, low, pull back up. Just falls short of an optimal trade entry, but that's why I don't use just the fib. We're not trading at just 62% retracement levels. We're using discount to premium. So high to low, it goes above 50. And it's at a breaker. And it's at New York session. And it's in a fair value gap, SIBI, sell side and balance, buy side inefficiency. All this down movement here gets rebalanced with this move up here. I use the analogy a lot with a paint roller. Okay, if you apply paint going down the wall here, you might have pockets where the paint doesn't get evenly distributed. So what do you got to do? You got to go back up there, right? Well, you can't go back up the same candle once it starts a new candle. So you got to wait until it does it at a later time. And then it does it here. So now it's rebalanced. All of this movement here is rebalanced with buy side delivery. Sell side, it goes down. To be efficiently delivered, it goes up. Once it does that, there's no need for it to go any higher. It can spike a little bit, but not like up here. That's not realistic. It's not expected. I never expect things like that. And over time, you're going to learn that you can sell in here and feel very confident that it's not going to go above this up close candle here, which is a bearish order block. That's your anchor point. Your stop would have to be above that. Entering in here, stop here, and you're reaching for some target on a low end. And again, just like I showed on the Eurodollar, it found the low of the day just ahead of the London close kill zone. Okay, and everything in these charts, okay, like the fair value gap in here, it trades back up into it, mitigation, okay, it's a high, low, high, it's lower. Once it breaks this down closed candle here, it trades back up into it here. What's happening here again? Mean threshold of the mitigation block. You see a repeating phenomenon and pattern there? It keeps happening, doesn't it? Okay, but you have to know what you're looking for. It's not supply and demand zones. Okay, they're very specific criteria. Like, how do you know which zone to pick? It's just like support and resistance. It's up for interpretation. But when you look at price and you see what it's doing relative to time, are the highs making higher highs or lower highs? Because that's going to differentiate whether it's a breaker or a mitigation block. But what price level do you use for the breaker or the mitigation block? What do you allow for drawdown in your entry? Well, let's just say, for instance, this low here, when it trades up to, that was where you entered. You have to be reasonable and flexible, really, to allow price to move as much as halfway into that mitigation block. That's reasonable. It's not likely to come all the way back up into the top end of it. That's not likely. Usually it's the butt end or the midpoint. But you have to use a bearish order block if you're using a bearish mitigation block to frame your stop. And that's in here. Now, when you have a big bodied candle like that, I'll use the mean threshold of that candle and not the highest high. If this was a small little stumpy candle that was up closed, then I would use the high. But this is a little bit of a range in here, so I would split that mean threshold, and my stop would be just above that by maybe a half a pip or a pip. And I would feel confident that it wouldn't go above the mitigation block and trade into the mean threshold of that candle.